So in today's episode, we are going to go over how to come up with the gap financing for assumable loans. Yes, you heard it correctly. How to come up with the difference from what is owed to what they're selling the property for in an assumable loan. So if you're into assumable loans, one of the common problems that happens is that if the owner owes a small balance on their assumable loan, you have to come in with the difference of whatever they owe and whatever they sell it for. Mike Yates with My Home Lending has a program that will actually help you come up with that difference so you can take over or assume that FHA or assume that VA loan. Welcome to the podcast, Mike. How are you?
Good, Jose. Thanks for having me.
I love it. So one of the challenges that we encounter very frequently is they have an assumable loan, they want to take care of it, but the buyer doesn't have the money to be able to come up with the difference from what is owed to what they're selling the property. So tell us about this program that you guys have.
Yeah, so what this is, we have one of our mortgage companies that we work with. They have a HELOC program that we can use that can bridge the difference for you. So we can go up to 95% of the purchase price or value of the property to kind of bridge that gap. So to kind of give you an example here, yes. Say there's a house for sale for $500,000. There's a VA loan on it for, or FHA loan with a balance of say $300,000. So there's, $200,000 we have to bridge there between the two. And that VA loan's at, 2.5%, and they really want to get that rate at 2.5%. But they don't have the difference, they have $50,000, but they don't have $200,000. So we can do a line of credit, the second position, that will go up to 95% loan to value, and that can bridge the gap for them. So therefore, they need to bring in approximately, $25,000
instead of the full $200,000.
Correct.
Basically. Yeah. So in a normal situation, in order to take over that loan, assuming it's a $500K purchase and they owe $300,000, you'd have to come in with $200,000 down. In this scenario, because it goes up to 95%, they would be willing to lend up to $475,000, which means you only got to come in with $25,000 as a down payment.
Correct.
That's probably the biggest challenge that assumable loans have whenever they owe a much lower balance. So walk us through, is the HELOC fixed? Is it variable? And then how long are these loans for? And what type of interest rates are these HELOCs?
Okay, so yeah, it's like your traditional HELOC for the most part. So a HELOC is a home equity line of credit. Most of them are very similar as far as we know. You can look at 10 different banks and they'll all be very similar for the most part. So with this particular investor, it's a 30-year loan. The first 10 years is what's considered your interest-only draw period. So say we did a line here of $175,000. You basically owe $175,000, and we would do a full draw at that point. So you'd be paying on the full $175,000, from the time of closing. The interest rates on these are pretty much always tied to prime. Prime rate is currently 7.5%. Word on the street is that should be coming down here, as time moves on. Whenever you hear the Fed cut rates today, that's when, the Fed chairman will cut the rate normally by 0.25 at a time. Hopefully in September, if all goes well, they should go down to 7.25. And then we're hoping for another drop later, so maybe down to 7% by end of the year if all goes well. But, currently it's 7.5%, and then there's going to be a margin on top of that. The higher the loan to value, the higher the margin. So in this case, if you go all the way to 95% loan to value with two loans, the rate's going to be right around prime plus 3%, give or take. So you're looking at a rate of about 10.5% on this. If they were to bring in, say, 10%, say $50,000 in this, you'd be closer to like prime plus 1.25. So a rate of like 8.5. So if you can do the 10% down, you get a little better deal. But, it's, on a loan that size, it's not that much of a difference on the rate because it's a smaller loan size. The payments are also interest only. So you're only making the interest only payment on that balance. You are more than welcome to apply any extra principal towards that balance any given month. So if you want to apply an extra $10,000 towards it, you owe $165, and your payment would actually adjust based on the $165. And then if you wanted to, you can actually draw on it again. So if you want to tap into that $10,000 later, you're more than welcome to. It's like a credit card tied to your house.
What happens after the 10 years?
After 10 years, it becomes payable back principal and interest. amortized over 20 years.
Okay. So basically, at that point, the payment would go up a little bit. Basically, at that point, because now you're contributing to the principal.
Correct. But in most cases, it's not as drastic as most people think. It's only a couple $100 in most cases because these loan balances are normally 100,000 to 200,000 on the high end in most
Well,
cases.
not only that, but like, let's say that somebody got a $500,000 loan and it was at 6.5%, basically. And let's say somebody was able to get a $300,000 loan at 2.5 and then a remaining balance at 10%. When you blend those two payments, a lot of times it's going to be lower than what you would have got at a 6% rate because your entire loan balance is at a much higher rate. So it's basically what you would do. There's something called the blended rate, which means that because you're taking over the assumable loan and you have that, then you can do that. Now, not only that, but like, let's say that you focus on the equity line of credit and instead of paying down your principal at 2%, you focus on paying off the equity line little by little. Now you're left with a 2.5% interest rate versus a 6.5% interest over the life of the loan, basically.
Correct. And also, don't forget too that in most cases that loan that you're assuming on the first mortgage, that's already been in place for 5 years, 10 years. So you're taking over a loan that's already a big, 5, 10 years into its amortization schedule. So you're taking over a loan that might have only 20 years left on it at that 2% rate or 2.5% rate.
Explain that in further detail, because I don't think so when I started investing in real estate, I didn't understand amortization. And now I look at it like taking over somebody's loan and I look at it, I'm like, oh my God, that's such a big benefit. Talk about like how that is a benefit. Like, let's say you take over somebody's loan that has already been in place for 10 years. How would that help somebody?
Yeah. So with any loan, especially a 30-year fixed loan, the first 5 years, even 10 years is so top heavy with interest. It's just the amortization schedule. Whether it's $100,000 loan or $1 million loan, it's the same type of schedule. So it's extremely top heavy with interest. So by the time you get down to 10 years into it, you're probably doubling your principal each month. That's going towards at least doubling, if not more, the principal going towards your balance each month. So you're really going to walk into a situation where you're just really just knocking out principal left and right. And you're also, only going to have that mortgage for 20 years compared to, taking over a new 30-year fixed loan with top heavy interest, higher interest rate. So if someone can take advantage of it, it's a no-brainer. It's a smoking deal.
Yeah. Now, who qualifies for this? Meaning okay, can anybody qualify? If you qualify for the assumable, does that mean you automatically qualify for this?
No, you still have to qualify, traditionally. So first and foremost, you need to get approved with the current servicer who has that loan is being assumed. Normally they're VA or FHA loans, sometimes USDA loans. So first and foremost, they need to get you approved to do the assumption for that first lien on the house. And then what we'll do is you have to let them know you're doing a second as well. They also need to approve that as well. That's not always a guarantee from what I've heard. So you definitely want to kind of make sure they're okay with that as well, having a new loan in second position up to 95% or 90%, because they need to sign off on that as well. But as far as qualifying goes, we'll qualify you just like a traditional loan for the most part. Make sure you qualify with the first mortgage, with the new second mortgage, and any other additional debts that you have. We need to make sure your debt to income ratio on this is under 43%, sometimes 45 with extenuating circumstances. But qualifying is just like a traditional loan in most cases when it comes to the qualifications.
Do you guys assist in any of the assumption process, or is that up to the buyer to take care of the assumption and then you guys just come in and plug in after they're approved?
We know of a company that can assist with that. They kind of specialize in kind of holding hands between both parties. They charge a fee for that. I don't know what that is. We have no part of that, but I know of somebody they actually specialize in that. Might want to recommend that because assumptions are kind of new. They're kind of coming back into the market. A lot of mortgage companies aren't really geared up for all this. So, having a specialist kind of stepping in might be worth the peace of mind for you.
Oh, 100%. Yeah, I know of a company called Assumption Solutions, and that's what they do basically as well,
Okay.
too. They basically
Yeah.
help people process assumable loans. Now, whenever you guys do a HELOC, I'm imagining there's also an appraisal on the property as well,
Correct.
too. Because
Yes.
on regular assumptions, there is no appraisal, and a lot of people don't realize that. But
Yeah.
if you're getting a HELOC in second position, then it would. Okay. And then the loan is a fixed loan, I'm
No,
imagining, or is that
no, the
variable?
HELOCs are always adjustable. They are tied to prime, and they're going to adjust up and down with the market based on what the Fed announces. So in most cases, when they go up or down, they normally go up or down by 0.25, a quarter% increments. These are smaller loans in most cases, so the payments might go up in most cases $8 or $9, you know, $12, $15 a time when they're increased or decreased. So it's not really going to affect your budget too much. And when we qualify you, the investor will use this. They use a little higher rate and actual higher payment than what the actual payment is to kind of plan on worst case scenario and be prepared for when it goes to principal and interest amortized over 20 years. So they use a little higher payment when it comes to qualifying just to make sure you're protected down the
Is
road.
there ever an option to go fixed or not an option on HELOCs?
Not with this investor. Some different HELOCs you have that option, but with this particular investor they don't.
Amazing.
But
Cool.
there's no repayment penalties. So if they want to pay this off in full, no harm, no foul. They can close it off. They can pay it off. Say they're going to sell another property, and they'll have a windfall of cash coming in here. From proceeds, they can pay that off. Then it's off the books, and they just have that loan at 2.5%.
Amazing. Okay. Anything else that we should know about the program?
No, it's just I just want to make sure people are aware this is out there. It's an option because one of the biggest hurdles we've seen on these assumptions is the gap. It's the difference in getting financing for that. So we think we're a good solution for that. We'd love to help out.
Amazing. Okay. Now, Mike, if somebody wanted to get in touch with you, how would they go about doing that?
Best way to do it is via cell phone. You can give me a call or text. Always available. My cell phone number is 805-407-5777. And like I said, always available, especially on weekends when I know people are looking at houses.
I love it. Okay, great. For our viewers today, we had Mike Yates with My Home Lending, Senior Vice President. We talked about how to come up with a gap financing for assumable loans, meaning how to come up with the difference from what is owed to what they're selling the property for. 95% loan to value on a HELOC. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be helpful to somebody, make sure to hit that share button. Thank you again, Mike, for coming on the podcast, and to our
My
viewers.
pleasure. Thanks, Jose.
Until next time.
Take care.